Good afternoon, ladies and gentlemen. Thank you all for attending today and taking some time out of your busy schedules to meet with us. Sorry for the tardiness and getting on here. Hopefully all can see visual here and can hear us on the audio as well. Again, we're Pinnacle Financial Services, as you know, and if you're on the call today, and we're very excited to be joined by quite a few folks with us. So we are joined by Chris Bailey over at Nationwide, as well as Mark Gleason, Travis Scavlin over at AllianceBernstein, and Michael Dioria at JPMorgan. So again, just really excited about the partnership that we have with Nationwide. If you haven't been on any of the previous webinars that we hosted here, this is a very exclusive distribution that we are really proud to be part of at Pinnacle Financial Services to offer this new Nationwide indexed annuity product. And I don't want to take too much of everybody's steam here, but going into any of the details with the product, I'll let the guys at AllianceBernstein and JPMorgan talk about the indexes, and Chris talk a little bit about the Nationwide story. But just really excited about our partnership with Nationwide, with AllianceBernstein and JPMorgan. Great options on the indexing front, and an A+ carrier with Nationwide with a really great track record in the annuity space. So I'll just sort of want to get you guys started. We have a lot to cover today. Don't want to take up too much time on housekeeping items, but just a little bit on our agenda. So I'll just start us off, pass to Chris, and then we'll hear from the folks over at AllianceBernstein, JPMorgan, and wrap up with some question and answer. So just if you're out there in the webinar space, we've done a lot of these recently, and I'm sure you've seen a lot as agents or advisors out there. You're probably getting invitations to webinars all the time. So we want to try to make it as interactive as possible. We want to hear from you and answer questions that you have. We have you all on mute today just to keep down on the background noise, but you could definitely ask those questions in the question box on the right hand side. So we want to, any questions that pop up, please ask away. And as always, if you have clients or prospects that come to mind that you think this annuity might be a good fit for, jot their names down. Let us know. We'll help you build the case, run an illustration for you, after the call. But any questions, definitely ask away, and we'll try to get to them as we go. And at the very least, at the end of the call, we'll wrap up and make sure we handle all the questions. So I think we'll probably run maybe about an hour or so with some Q&A at the end. So just with respect for everybody's time, thanks again. And without further ado, we'll just try to get to the meat and potatoes here. So I want to show you all my team here at Pinnacle Financial. We have a ton of great people here devoted to your business, and a lot of times, you might work with one of us on the sales side, one of the sales folks, and think that that's your only contact here, and it's not. We have, as you can see, myself, Josh Horton. I should have introduced myself a little bit more clearly, but I'm our vice president over here, assistant vice president on the life insurance, annuities, and long-term care. Really everything that is not Medicare for us here at Pinnacle. If you're already an agent with us, you're working with us, you know that we're a big Medicare shop. So just dealing with a lot of our Medicare producers, I always say, hey, anything that's not Medicare, you can call me about. And where my focus is more the annuities, as well as Will Torrance, my colleague there at 7790. Will and myself really focus mostly on the annuity business. So we'll be head manning this Nationwide partnership. So anything Nationwide related, just call me or Will. Happy to help. And then I have Mark Bolger and Warren Redinger that are the life sales directors. Life insurance, final expense, any of that stuff, those guys are there to help. And then our support team, who are really just an extension of your staff if you're an agent with us. Their whole job is tracking your business, making sure everything runs smoothly, everything from scrubbing an application. If you're still doing a paper application, we want to make sure everything looks the way it should before we submit it for you, and make copies of everything. And if you're transferring money from one institution to nationwide for your nationwide annuity, and we're having an issue getting those funds over, that's where Bill Vandergriff, Dave Baranek, those guys are in here bird dogging those transfers for you. So just you can see the extensions for the whole teams too. If you need, if you hit the sales team extension, it'll come to one of us. Same thing with the new business team. But we are what you would consider an FMO, IMO. If you're in the insurance space, it's really just kind of some industry jargon. We're a partner with our agents, advisors. That term is really just sort of the top of the commission hierarchy. So top level commissions, if you're working with us, especially with this nationwide exclusive distribution, we have some really nice commission arrangements with Nationwide that we can share with our agents, so we're happy about that. And you're fully vested with any of the business that you're doing with us. So I always like to mention that. I'm an agent myself. Most of our sales team here are licensed advisors, agents, and so we know there's a lot of different commission agreements, arrangements out there in our business. If I think about how I got started right out of college, the type of commissions that I was earning, it's important to know that if you're working with us, your commissions are paid directly by the insurance carriers. They're direct contracts, and you'll really be realizing some nice commissions. So we can talk about the percentages. We're very transparent with that. We usually have some different agencies on these calls. So if you want to know the nitty gritty on that, just get with us afterwards. We'll make sure to let you know. But we really have experts that specialize in all the different areas of the financial services field that we focus on here at Pinnacle, kind of that senior market. But if you have a life insurance prospect, our team here are experts on the life insurance. The annuity side of things, I've been in the business now about a dozen years, focused on the life insurance and the annuity side of the business. Will, my colleague, has about double my years in experience and has worked with a number of different brokerage firms and different insurance companies. So we have a ton of experience, not only on the brokerage side, but also in the field selling, just as you are, as agents with us. So we know what it's like. We want to make sure your business runs smooth, you get paid on time the way you're supposed to, and then you can move on and hopefully find more clients, and that's how we can work well together. But we have a ton of different tools that we offer to our agents for free. We won't go into those today, but from quoting right on our website, lots of different quoting tools. We offer a annuity rate watch illustration software for free to all of our advisors for the annuities, and then we have life insurance, long-term care, Medicare quoting tools all there on the website for free for you, and just a ton of other stuff. I mean, if you need help finding clients, marketing, we have a number of different lead programs or pre-appointment appointment setting programs, even that we sort of you benefit from our trial and error. If you're working with us, we've seen a lot of different things that maybe didn't work very well, and so if you're needing help with marketing, we would recommend something to you that we're seeing other agents, other advisors having success with. So if you need help finding clients, let us know. We're really happy to help there. I really think of that as the hardest part of our business is really finding the clients. So, with that said, we can help you with your closing ratio. If you need help with, training on anything, everything from how to present an annuity to a client. What if I'm going out on an appointment and I'm not comfortable doing the fact finding where I don't know what I'm going to sell and I need to ask some questions in order to determine the client's needs? We're happy to help with training on that. And if you're more experienced and you don't need help on that end, but maybe you'd benefit from us doing illustrations for you. our team here, happy to do the illustrations for you or get you set up so you have the capabilities to do all of that stuff on your own. So we'll help you really from soup to nuts, start to finish. As I say, just let us know, how we could fit in with your business. So with that said, I want to move things along and get to Chris here so we can talk about Nationwide Peak 10. So Chris,
sure. Thank you,
yes,
Josh, for the introduction and the opportunity to participate in the presentation today. This is going to be. Can you guys see my screen? Yeah. Okay. So I've actually spoken on a couple webinars for Josh and Pinnacle. We went through Peak 10 as far as the product. Okay, talk a little bit about why Nationwide. Being the mutual insurance company, been around 100 years, A+ rated, Fortune 100 company. I think as a follow-up to this, we now want to really, and we teased this last week. We wanted to kind of give you an idea of a deeper dive into the different indexed options that you and your clients have available when they purchase Peak 10. You've got really 4 great brands behind you and working for you with the Peak 10 product. You've got Pinnacle and your partners there. You've got Nationwide. You have AllianceBernstein with the Growth and Value Balanced Index, and we have JPMorgan with the Cycle Index. Peak 10, if you were on the last 2 webinars I did for Pinnacle, or one of the last 2, it's really a product that's going to be a fit for many clients. Fixed index annuity that has a great income story with both the no cost built-in guaranteed income solution that's going to give clients a guaranteed 4% roll up on their income benefit base, really for clients that are unsure if they want to use this product for guaranteed income, but have the flexibility to turn that on should they want to down the road. And then we have the 4 cost, which is the bonus income plus rider. So from an income standpoint, this is going to be one of the top products out there, but it's also a top product in accumulation. And what makes accumulation, this product so attractive for accumulation, is the indexed options that are included inside of this product. Both the Growth and Value Balanced Index from AllianceBernstein and the Cycle Index from JPMorgan are completely exclusive to Peak 10. So as a follow-up, we wanted to bring on Mark Gleason and Travis Scavlin from AllianceBernstein to dive deeper into Growth and Value Balanced Index, and then Mike Dioria from JPMorgan to really get into the Cycle Index that's part of this product. So first, we're going to have AllianceBernstein up. Mark Gleason and Travis Scavlin will be going over the index and what you can expect to see. Talk a little bit about the partnership with Nationwide, how we partner with JPMorgan, and really the philosophy around why this index was created. So Mark, I'm going to go ahead and kick it over to you to get into this.
Great, thank you, Chris, and thank you everybody for having us. I'll just echo Chris's statements. We're extremely excited on the AllianceBernstein side to be partnering with really this many great partner firms, Pinnacle, Nationwide, JPMorgan. It really is a bit of a who's who when you talk about some of the giants in the financial services space. So really excited to get out there, help you all tell the story. As Chris mentioned, I'm Mark Gleason. I work on our multi-asset business development team. I'm joined by Travis Scavlin. We're both product specialists on the index side. So I'm going to give just a very brief overview of AllianceBernstein, the firm, and the multi-asset group within it that designed the Growth and Value Balanced Index before passing it over to Travis, who's really going to get into nuts and bolts about the way we constructed it and what we think is really the differentiated message we can all tell. So if you move to the first slide, just to talk about AllianceBernstein, the firm, we really are a global firm. And we think that that is really integral to the success that we've had as a group, is having perspectives from boots on the ground folks all over the world. So we have 18 offices that span the globe. We bring to bear, a tremendous amount of resources, both on sort of the analyst side, almost 200 folks who are doing research and analysis on capital markets all day, every day, almost 140 portfolio managers, again, that span this global footprint, which we really do think is a differentiator in the way in which we can build product, right? And that's ultimately what matters the most, is it's great to have offices in a whole bunch of different places, but only if that improves your investment results. And we really do believe that it does, and we've seen evidence of that in a number of different places. If you move to the next slide, we can just take a snapshot of the business today. So AllianceBernstein currently manages almost $700 billion in client assets, $686 billion. Asset management is the only business that we are in. You can see the way that we are split from an asset class perspective. So a pretty diverse mix. We have a big fixed income franchise, but we also have a tremendous amount of scale and assets in the equity and the multi-asset side, and a growing alternatives business. Those sort of mandates are global in nature. So we do a tremendous amount of global investing, again, leveraging that footprint, and our clients are everywhere. We have a big presence in the Americas, but also a very significant business in Asia and in Europe. So again, truly a global approach to the asset management world. If you move to the next slide, this is just a little bit of detail about the group that actually built the index we're going to talk about today, the Growth and Value Balance. So this is our multi-asset solutions group. 163 billion of the firm's overall assets. So about a quarter of all the money that the firm manages is in multi-asset solutions, multi-asset approaches like the Growth and Value Balanced Index. You can see the way we segment the business in terms of outcomes we're looking to generate for clients. You can see that index and that factor business and the size and the scale of it. So obviously an important piece of business to the firm at AllianceBernstein, and really that importance translates to resourcing and scale. So 44 investment professionals, that's vice president and above, researchers and portfolio managers who only focus on multi-asset, right? These people are dedicated to multi-asset investing. We're not believers in, taking a great equity strategy and a great fixed income strategy, stapling them together and calling it a best in breed multi-asset. We think you have to sort of be in it, live it, breathe it every day. These people are very tenured. And we're also fortunate to kind of reside in the organization that we do, right? So I mentioned that equity and that fixed income business. From a multi-asset perspective, we're fortunate we get to leverage those people, get their insights, get their research, et cetera. And it really is a big, we think, advantage for multi-asset at AllianceBernstein. Just to close on sort of the firm stuff, the next slide just gives a snapshot of our insurance-focused team. Insurance is a massive focus and a really important piece of business at AllianceBernstein, and as such, we've resourced it with folks who are dedicated to insurance, know the business, know the space, know how the client conversations go, et cetera. This team's led by Mike Hart. Some of you may have seen Mike or might see Mike in the field, hopefully sometime soon, but certainly on webinars and Zooms. We have dedicated folks in each region. These are all listed here. If anyone wants this information and doesn't have it, please let Chris or myself know. We'd be happy to make sure everybody has this in hand so you know who to call, reach out to. If you have events you need support, if you have questions on the index, anything like that, we're more than happy and really excited to help you all. And then I mentioned myself and Travis as really the specialists on the product, a little bit more into the depths if you have clients who are really interested in how this was put together and how the rule book works, all that stuff. We're more than willing and able to answer all those questions. So a well-resourced group that's really excited to help you all go out and talk to clients. With that, I'm going to pass to Travis to get into a little bit about the story of the index, how we built it, and why we're so excited to go out and tell the story.
Awesome. Thanks so much, Mark. And afternoon, everybody. At the point of sounding redundant here, but do just want to echo kind of the comments that Mark made and Chris made of how excited we are, especially from the AllianceBernstein side, to get this story out and to work with you and introduce it to your clients and your prospects. We've built something that we feel is compelling and differentiated, and we're very excited to introduce it and kind of run through the why and where for a little bit today. So we'll start on the screen, and what we've kind of done here is break out what we see as kind of the key themes or the three kind of key selling messages behind the Growth and Value Balanced Index. And we'll run through them a little bit more in depth, but really at its core, the index is a combination of the power of growth and value equity investing married with a concept of a flexible fixed income allocation or sleeve to deliver what we see as the maximum diversification potential along with a consistent return profile. And we do that through, like I mentioned, those three kind of key components that we've outlined in the middle of the screen. First, responsive allocation shifts to protect in down markets and still participate in up markets. We think that simply allocating to an all stock index really does leave a conservative investor, especially, overly exposed to the swings of the broader market. And by investing in a balanced index that utilizes the power of fixed income and equity, you're building in a cushion to those equity market swings without dramatically diminishing total return expectations. Now, secondly, kind of the cornerstone of the index is this idea of unlocking equity potential through growth and value investing. We've found that simply investing in growth and value has historically produced more compelling results than a broad allocation to market cap weighted indices. And by capturing the winner of that growth versus value rotation, we've seen that that's even more efficacious for most investors. Now, finally, the last component of the growth and value balance index is this flexible fixed income allocation that's really designed to meet changing market conditions. By dynamically shifting between 10 and 2-year bonds, capturing the rotation between longer and shorter duration fixed income, we've seen that the index can still provide the protection benefits that are offered by bonds, but minimize the drag that they can contribute when we get into some of these more rising rate regimes. Moving on to the next slide then, we'll take a look at that balance component. And I think we can all, at the outset, admit that equities are, hands down, the growth engine of any portfolio. And we're showing that on the left-hand display, just going back to January of 2000, that the S&P 500 has historically been that growth engine, right? You annualize on average over 4%, but not every investor can handle the ups and downs and the swings that come with that long-term performance. And we get at that a little bit in the display that we're looking at in the middle, where we see that if you go back in that same period, there's been over 14 quarters in that 20-year period where the S&P 500 has actually fallen by 5% or more. And if you annualize those 14 quarters, what you come away with is a pretty negative market, almost 13% for the S&P. But bonds, whether they be 2-year or 10-year notes, have offered a cushion or an anchor for your portfolio during those down times. So the entire crux of this balanced construction, really and truly at its simplest, is leaning into stocks and calm markets and leaning more assets into bonds when markets are stressed, leading to a smoother, more consistent return profile. Now, the index has been responsive throughout history. As we can see on the right-hand side, we've dipped as low as 7% equity allocation during that trough of the great financial crisis in 2008. But as markets recover and as we see a risk-on environment, the index has the flexibility to kind of take on that risk and go as high as 73% as we saw in 2017 on that final chart. So transitioning into the next slide to look a little bit closer at the equity component of this, I've mentioned the idea of rotating or capturing the rotation between growth and value being the cornerstone of the growth and value balance index. What we're showing here is just how dramatic on the left that outperformance can be. In kind of the darker teal, you can see that growth outperforms in some years, and at the same time, value in the lighter green will outperform as well, and those swings can be rather drastic. Combining those two ideas into one portfolio, even in a simple, naive 50-50 allocation, we show on the right has been historically effective at producing more compelling, more consistent returns than just a broad allocation to the S&P 500. If we can transition to the next slide, then we'll keep that same idea of being dynamic in our allocation going and look at the fixed income side of the world. Now, there's a lot going on this slide, but what we're really getting at is that historically, longer duration, think a 10-year note, bond has provided the protection that you expect in a portfolio. But in environments where rates start to move up and that duration risk begins to play out within a portfolio, these longer duration bonds tend to get hurt a little bit more than their short-term counterparts. So if we go from left to right in kind of these columns, you can see in the last 4 periods of significant rate moves, short duration bonds have either been flat or just slightly negative as compared to their 10-year counterpart, meaning that you still do have that balance within the portfolio and the downside protection that you expect from your fixed income allocation. So if we think then about how we put this construction together and how we marry these ideas and investment concepts, the next slide begins to walk through how we actually build out the methodology behind the product. So we'll start with the equity sleeve and use momentum signals within growth and value to lean into recent winners and away from recent losers. Once we've gotten the balance of growth and value correct, we'll go ahead and smooth the overall volatility picture of the equity sleeve to a 5% target to start the process of maintaining that smoother, more consistent performance pattern. Now, if we look on the next slide, it's going to feel very similar to this because we're capturing almost the same concept, being dynamic and creating the allocation between 2 different components within the allocation. When we look at the momentum signals between fixed income, between 10 and 2-year bonds, and get that right, we'll apply the same process of a 5% volatility target to the fixed income sleeve. And that'll lead us to a final step on the next page of marrying these 2 separate portfolios together into one to create an overall portfolio that is, again, volatility targeted to 5%. Now, I mentioned that a few times, but I want to pause and kind of hit on the iteration of volatility targeting at multiple stages of the portfolio and how instrumental that process is in creating a more balanced exposure than other approaches that we do see in the space. And we can see that a little bit on the return stream that we'll end on here on the next slide, where we do show very compelling index returns, but I think even more importantly, we show a more consistent pattern of fewer 0 years when we think about the index within that overall crediting strategy, reducing those years where clients get a 0 on their statement. So I'll pause there and pass it back to Chris, and just again, thank everyone for their time this afternoon and express how excited we are to partner on this opportunity moving forward.
Perfect. Thank you, Travis. Thank you, Mark. You know, that was such great information. You know, on prior webinars, I went through, you know, kind of high level on the Gavel or the Growth and Value Balance Index. I also did the same for Cycle, and I thought I did a great job of listening to you and Mark. It's you guys are so intelligent, and providing your expertise is always beneficial. So with that, I want to next bring up Mike Dioria from JPMorgan. You know, Mark and Travis alluded to this. You know, they've got a team dedicated to going out and talking to the index that they have, the indexes they have inside of insurance products, whether that's IUL or annuity products. The same thing is true for JPMorgan. That's really why the partnership works so well between Nationwide and these 2 index providers, is because they provide no shortage of resources and no shortage of support in driving their index inside of our products, whether that's fixed index annuities or any type of life insurance products we may have one of their indexes part of. So thank you, Mark. Thank you, Travis. But I do want to bring up Mike Dioria. He's the executive director at JPMorgan. He manages the team that is responsible for going out and talking to this JPMorgan Cycle Index. So with that, Mike, I'll go ahead and pass it to you.
Great. Thank you, Chris, and thank you, Josh, for the opportunity to be part of this launch, or the Peak 10 launch. Again, I know everyone said it already, but JPMorgan and myself, we are extremely excited to be part of the Peak 10 launch. It's an incredible opportunity for JPMorgan. I'm sure the AllianceBernstein team feels the same. The success that Nationwide has had with annuity, with fixed index annuities, just gives us a lot of comfort around, if we continue to support this launch, it will be an incredible success. So really want to talk about some keys to success. And although I'll be focusing on the Cycle Index, it's really important, or I feel it's really important for everyone on the call to understand what has been driving the success in some of these prior experiences. So how do we keep this simple for you? And then the simplicity sometimes leads to that success. So Chris, if you can move to the first slide, really want to talk about the three pillars of success that we see. The first one is brand. You have four incredible companies and four incredible brands partnering on this Peak 10 product, right? Pinnacle Financial, Nationwide, AllianceBernstein, they always do a great job with detailing the Gavel Index, and then JPMorgan, all of which are companies that have a proven track record in award-winning index design. So leverage those brands. If you're speaking to a client, right? JPMorgan, AllianceBernstein, Nationwide, these are recognizable, high-profile brands that really can get that conversation started. And then consistent throughout everyone's presentation is support. There's a ton of support that we have available. Know and use your resources, right? Never hesitate to reach out to a Nationwide, an AB, or a JPMorgan about what are the resources that are available, because at your fingertips, and you may not know it, but you have a broad network of support. And you have partners that are dedicated to support your sales efforts. That's what our teams are designed to do. How can we help you be better at selling the Peak 10 product? And we'll all do it in different ways, but you have a ton of resources available for you. And then lastly, and most importantly, the product. You have a best-in-class product. And I know that there's four indices, and there's the S&P 500, there's the Dividend Aristocrats, but the AB Index and the JPMorgan Cycle Index, these are differentiators. These are two indices that are unique to the Peak 10 product, exclusive to Nationwide and this product, available for you. Right? That is something that is unique to only the Peak 10 product, and that should help differentiate conversations. So just want to dive into each of these three keys to success individually. The first being the brand. And I updated this slide just recently with JPMorgan's 2020 results. So talking a little bit about JPMorgan's strength and stability, and I have to imagine everyone is familiar with JPMorgan and one of the most recognizable CEOs in Jamie Dimon, but we can trace our roots back to 1799 with the establishment of the Bank of Manhattan Company by Aaron Burr. In addition to that, I just learned that JPMorgan Chase is ranked by S&P Global as the largest bank in the US, and we moved from the 7th largest bank in world total assets to the 5th largest bank in the world in total assets. So quite compelling when you think about who is behind this index and who is working on this index design. And then the last point, which I find extremely interesting, is serving nearly 63 million US households, including 4 million small businesses. If I'm not mistaken, and I have it written down here, there's approximately 123 million US households in the United States. So that means JPMorgan touches nearly 1 in every 2 households in the US, which is pretty amazing. When you look at the pie chart there, top left, total assets, 3.2 trillion as of Q4 of 2020. Bottom left, 119.6, or almost 120 billion of total net revenue. And the top right, almost 29.1 billion of net income. So pretty sizable when you think about, JPMorgan and our balance sheet and what we have the ability to do. Globally, we employ over 256,000 individuals. So again, that's JPMorgan's strength and stability. If we talk about the resources that are available to you and the support, it's a powerful partnership. And Chris alluded to it. We have a team of dedicated index specialists, 6 individuals, including myself, and I manage the team. But in 2020, working with Nationwide, we had over 800 interactions with wholesalers, agents, and so forth on Zooms, WebEx, Teams, office visits, in-person meetings when we were able to early in the first quarter, but emails, phone calls, right? We have the ability to engage with you, engage with your clients, and again, continuing to support you in the way you need to be supported. We have an additional 10 sales support analysts. You can see there's a sales support line. Any question related to the JPMorgan Cycle Index, performance, methodology, investment universe, all it is quick dial the 1-800 number, and we'll have a sales support analyst able to help you. And if not, point you in the right direction. And sometimes that may not be JPMorgan, it might be about the Peak 10 product, and we can bring that question right back to Chris Bailey and his team in Ursula Welch. And then lastly, all of the support you could want. And I know that Nationwide's going to provide it. AB certainly provides it. Merrill Life, Pinnacle, everyone will provide you with index marketing materials, but we have it as well. Monthly performance updates, monthly index commentary, an investable index website that you can track the performance from the anniversary date to the crediting date. Again, all of the resources are available. If you know your resources, you can become more efficient and more effective. I want to move on to the index itself. The index design, very important to keep it simple. Anything that's not simple becomes more challenging to be able to have that conversation with your client. So the JPMorgan index is extremely simple. It's a balanced index. What does that mean, balanced index? It's going to be comprised of two components, an equity component and a fixed income or a bond component. That's all it is, balanced, equities and fixed income. What's unique and what makes the JPMorgan index different is the way we think about allocating to the equity constituent. And what we use is the business cycle. And that's thusly why we call it the JPMorgan Cycle Index. We think about market conditions and the business cycle. So equity style rotation that's tailored to the business cycle gives us the ability to overweight the portfolio with the type of stocks that have historically performed well during each phase of the business cycle. I'm sure most of you, if not everyone on the call, is very familiar with the business cycle. So we think about top left, slowdown, contraction, recovery, and expansion. During each part of the business cycle, certain stocks typically outperform. So in slowdown, if you think about a slowdown, right, what are the type of stocks that typically outperform in a slowdown? Well, you have low volatility stocks. In a contraction, quality stocks typically outperform. In a recovery, value stocks. And then what most of us are familiar with more recently when we think about the most prior experience, expansion. Momentum stocks, growth stocks have typically outperformed. So our index, although balanced, very simple stock and bond portfolio, the stock constituent is going to be focused on the business cycle. Where are we in the business cycle and how do we overweight the portfolio to those type of stocks throughout the business cycle that will historically have outperformed? So if we go to the next slide, we talk about how this investment style works. And everyone can see the sphere there. And if you're getting an opportunity to read through all of the components, right? The index is made up of 5 portfolio components. That's what we said. But at any one time, you're only going to be invested in one of the equity constituents, whether it's min-vol, momentum, quality, or value. The other part of the portfolio is going to be the fixed income component, which is going to be the JPMorgan Core Bond Index. So you're going to have a balanced portfolio between one of those equity constituents, depending on the business cycle, and then you're going to have you'll have exposure to the fixed income constituent, which is the JPMorgan Core Bond Index. On the following slide, this is the index methodology. It's extremely simple. The JPMorgan Cycle Index monitors leading and lagging economic indicators and takes the following steps each month to generate more stable growth for the portfolio. Step number 1, identify the current phase of the business cycle and choose the corresponding equity allocation. We saw that on one of the first few slides. Where are we in the business cycle? And what are the stocks that typically have outperformed during that part of the business cycle? Well, that's step number 1. Identify it, leading and lagging indicators, and determine where we are in the business cycle. Select that equity allocation. Step number 2, rebalance between equities and bonds and target 5% volatility for the portfolio over time. I'm not going to go through targeting 5% volatility. Travis did it eloquently just before on the AB talking about Gavel, very similar. Targeting a level of volatility gives you a smoother, consistent, stable profile, and that's what we're doing in both indices. And then step number 3, rebalance again mid-month whenever economic or market conditions change considerably. And in our index, if volatility of the index doubles, that's when we're going to reevaluate and allocate again between the stock and bond constituents. So step one, identify the business cycle, choose the corresponding equity allocation. Step two, rebalance the weights between equities and bonds, targeting 5% volatility. And then step three, in the event market conditions change considerably, rebalance mid-month. I really like this slide. I find it so important. And a lot of people always say to me, Mike, if you're making the case for the JPMorgan Cycle Index and you're showing historical performance in which the S&P 500 in the time period that you're offering significantly outperforms the cycle index, why do you do that? And my answer is very, very simply, if you look at the trajectory of the S&P 500, which is the yellow line, yes, it certainly has outperformed, but look at the volatility of the S&P 500 from 2004 to 2020, right? There's not a smooth ride, right? That experience is very choppy. But if you look at the performance of the cycle index, and again, targeting 5% volatility for the Gavel AB index, and I keep drawing a lot of comparisons because the index design, a lot of the fundamentals and principles are similar, right? A steady, consistent return gives you greater opportunity for interest crediting. And in the construct of a fixed index annuity, it's not always about how much performance. It's about how often does the crediting strategy interest, or how often does it credit interest? So, Chris, thank you for going to this slide. Let's talk about the impact of lower volatility, right? This index is designed to keep volatility low over time to offer more consistent returns. So what we're showing you here on this slide, and one of the contributing factors for Nationwide selecting the JPMorgan Cycle Index, is because when you look over history, you can see that the JPMorgan Cycle Index gives you more opportunity, or it credits interest a greater percentage of the time than the S&P 500. If you've selected the one-year cap strategy, 82% of the time you would have received interest if you selected the cycle index versus 81% of the time. If you go to the 2-year participation rate, which Chris has shared, most individuals selecting a crediting strategy have selected the 2-year par rate strategy over the 1-year cap strategy. 89% of the time, cycle index has credited interest versus the S&P at 83%. So again, it's not just about the performance of the index, but how often does the index credit for your client? And that is really one of the most important things when you think about the two indices that are being exclusive to the Peak 10 product in the AB Gavel and the JPMorgan Cycle. On the following slide here, very similar to what AB had showed, is again, not always about performance. How much interest and how often does it credit? Because the product that you're purchasing is a fixed index annuity. It's not the return of the S&P 500 index. So in this example here, which we use a 1-year cap strategy, 3% caps on the S&P versus a 4% cap on the cycle index, you can see without a cap, yes, certainly the S&P 500 outperforms and returns 7.33%, bottom left-hand corner, versus the cycle index, which is 4.64%, right in line with expectations. 4 to 6%. If you're targeting 5% volatility, expectations are going to be 4 to 6. But again, this is a principal protected fixed index annuity. Manage those expectations. Well, if you use a point-to-point crediting strategy, the S&P 500 2.24% is below 2.62%. That's with a 2019 return on the S&P of 28.88 and an S&P return of 16.26. So again, always frame the return of the index in the construct of the fixed index annuity and the crediting strategy, because I don't know of an FIA offering currently uncapped 100% or leveraged participation to the S&P 500. So thinking about consistent stable returns, smooth targeted volatility, right? Smoothing out the trajectory of the returns really enhances the return profile when you think of the construct of the fixed index annuity. So To conclude, I want to touch on the three most important things that I mentioned today. Number one, the brands. Leverage the brands. Great companies, use them. Very helpful when you have that initial conversation. Secondly, resources. Know your resources. Everyone is here to help support your sales efforts. What we can do to help you be better, don't hesitate. Reach out to the Nationwide team, the AB team, the JPMorgan team. And then finally, best-in-class product. The Peak 10 product is an incredible product. It's currently only available to you. Make sure, I would say, certainly highlight that there's so much exclusivity with this product that it's unique and it's best in class that you can be offering to your clients. With that, I want to turn it over to Josh. I believe we may be moving to question and answer.
Awesome. Thank you guys so much. That's some really, really great stuff and some good detail. I did have a couple questions, so let me just kind of switch things just so you guys can see my number again. If you do need to reach out to us here at Pinnacle, so you'll be able to reach me there. There's my, it'll be up in a second. Extension 7707. There's our 800 number. And if you're not contracted with us already and you'd like to get set up with the Nationwide annuity, absolutely let us know. We'll get that started. All right, so just a couple questions, and the first one was sort of directed either the JPMorgan, Mike, you can snag this, or Mark, either one. I think it's directed either way. The question was, how does JPMorgan or AllianceBernstein make money in dealing in this annuity market? Essentially, kind of a good question, right? Why are you guys doing this?
Certainly. Now, I'll take it first, and then Mark, maybe you can jump in afterwards. There's two ways. Number one, index sponsor, right? As an index sponsor, there's a fee for JPMorgan licensing that index, and then number two, it's also the hedging of the option. So Nationwide would purchase the option from JPMorgan, and then because it is a JPMorgan index, right? JPMorgan would earn a spread on that option, selling it to Nationwide. So if the greater the premium selected for the JPMorgan cycle index, the more options or the greater amount of notional the Nationwide team would buy from JPMorgan, and there would be a slight markup on that. That's two ways in which the investment bank JPMorgan would be making money. Yes.
Got it. No, understandable. I thought that was a good question.
Mark, is there anything to add or?
No, I mean, my view, it's even simpler for us because we don't have an investment banking arm. We get paid a licensing fee by Nationwide for the assets that we raise tied to the index.
Yeah, that's kind of what I was thinking, Mark. So it makes sense. Absolutely. And just if you guys have any other questions, now would be your time, obviously, to go ahead and ask away. So anything that comes to mind, we would love to hear from you. It looks like just one more directed at you, Mike. On the JPMorgan index, why a balanced index instead of a growth index, given the a more growth-oriented index, given the zero floor nature of indexed annuities?
Certainly. So if you think about, you could do just a simple growth index and not pair it with a fixed income component, but then you would be uninvested in a large portion of the portfolio. If you're targeting a 5% volatility, you may only have up to 30 or 40% exposure to the equity constituent, and then the remainder being uninvested. If you look at a balanced index by partnering it with the fixed income constituent, it gives you the opportunity to earn a greater return based on diversified fixed income contributing to the performance of the index. So when you run the back testing, a balanced index historically can outperform versus just a growth only or an equity only index, which will have only partial invested exposure to the equity constituent.
Great. Thank you for that, Mike.
I'd like to jump in on that one because I think the Gavel index is also slightly balanced, and you guys, right?
100%. So I think there's two things that I would highlight. One is obviously there's a crediting advantage of having a balanced approach, which gets you lower volatility on average, right? So there is a benefit there, but I'd go a step further and say that there's a bona fide investment case as well, right? Like Travis covered, we know that equities will be the growth engine, but we also know that in periods like March and April of last year, if we're trying to generate positive performance, owning a more diverse set of asset classes greatly improved your chances to post a positive year. So it does help you on the crediting side, but it also increases the likelihood that you generate a positive number over longer periods of time.
Yep, gotcha. Thanks, Mark. And looks like we got one more, just one more, and this might be more for you, Chris, if you're still out there. Question was, can agents post information about this product on their website, or are there any restrictions not allowing advertising an annuity product?
So we did create, and I know, Josh, you guys have the pre-approved materials for posting on websites. So Josh, if you could, do you have those by chance?
I do.
Okay.
I was going to let you speak to it. Yep.
Yep. So as far as advertisements or marketing that you as advisors would create, Nationwide would need to review those and approve those. But to make it easy, we actually did create some pre-approved messages. It's basically a template where you can kind of plug stuff in. So Josh will provide that to you, but anything that you would create, we would need to review and approve. Anything that, and you're open to use any of the pre-approved stuff that Josh is going to provide.
No, absolutely. Well, great questions, everybody. Thank you for those. It looks like that's all we had. So I think we did pretty darn good on time there, gentlemen. So I wanted to keep you guys to about an hour. Well, we thank you all for your time once again. We would love an opportunity to work with you on your annuity business, whether it's with this Nationwide Peak 10 or any of the other products. So again, if you're not contracted with us and you're interested in doing so, visit our website, pfsinsurance.com. You can contract right there, or I can send you paperwork to do it, do the paperwork that way as well. So again, thanks everybody for your time, and thank you, Chris, Mark, Travis, Mike. We really appreciate you guys taking time and your expertise. So thanks again.